Have you ever felt that now just isn't the right time to invest? The market is crashing, or the market's too high and you're a little bit afraid, or you're just waiting for that perfect moment. Let me tell you a quick little story about three different people and what it cost them exactly. All three of these people started with $10,000. And right before one of the worst crashes in history, we're talking about the 2008 financial crisis. One waited, one bought at the absolute worst time, and one waited for that perfect timing. Who do you think won? Let me know in the comments down below before you continue to watch here. And the right answer might completely change how you invest. Let's jump into this quick little story. Let me introduce you to Sarah. Sarah's known as the waiter. She looks at the market in 2007 and says, I think this market is way too hot. So she waited. She kept her $10,000 in savings, and then the market crashed. 2008. She looked like a genius. She blurts out to all of her friends, I knew it was going to happen. But then something interesting happens. The market starts to recover in 2009, and Sarah says, it's still too risky. It might drop again. So she waits. She waits until 2010. She waits in 2011. Year after year, she continued to wait. Fast forward 10 years, Sarah finally decides to get in. Yes, she avoided the crash. She also missed one of the biggest rebounds in history. She didn't lose her initial $10,000, but she lost time and all that time allotted her. Let's jump into the next character here. This is Bill. Bill actually does the complete opposite. Bill invests his $10,000 at the absolute worst time, right at the top of 2007. Then the crash hits. His $10,000 is cut in half. Emotionally brutal, right? Most people would quit right here. But Bill does something different. He does nothing. He doesn't sell. He doesn't panic. He just holds. By 2013, he's back to at least even. And 2017, he's got a pretty solid profit. His timing was absolutely terrible, but his behavior was pretty decent. Next up, let me introduce you to Gerry. Gerry waits. He gets it exactly right. He invests his $10,000 in 2007, notices that the market is coming down in 2008 and pulls out and invests right away in 2009, right at the bottom, right when fear was at its peak. His money takes off almost immediately. He looks like a genius. And yes, Gerry ends up with the highest return. But here's the part that nobody talks about. The difference between Bill, who got in at the absolute worst time, and Gerry, who got in and out and back in again, isn't nearly as big as you'd expect the difference to be. Because over time, Bill's simple buy and hold strategy actually catches up to Gerry. This is the lesson that most people miss. You don't need perfect timing to win. Even if you invest in the worst possible moment, if you stay in the market and you continue to invest, you still come out ahead. Trying to time the market, forget about it. You have to be right twice. When to get out of the market and then when to get back in the market. And Sarah, the waiter, she proves exactly what happens when you don't. Let me say this clearly. Waiting feels smart, but it often is just fear in disguise. And fear keeps people stuck for years. The market doesn't reward perfection, it rewards participation. So don't be Sarah trying to wait for perfect. Don't stress about being Gerry and trying to get in and out and in and out. Just be Bill. Be smart. Stay in. Continue to invest. And let time do all the work. Here's the thing. Pick a number. Any amount of money that you feel comfortable that you can invest and stick with it. Automate it so it automatically is contributed to your investing accounts. And don't look back. It's as simple as that. Your future self, they won't care if you time the market. They'll care that you didn't wait to get into the market. So if you found any of this information helpful, if you liked the story, leave a comment down below. Would love for you guys to join us next week. Until then, see ya.